I'll guarantee you that a very significant percentage of our business is one way affected by it. But they're being affected by a lot of other things too. And the real question is where are those businesses going to be in 5 or 10 years? They'll have ups and downs. Our candy business is a wonderful business, but it loses money 7 months out of the year. The nice thing is Christmas comes every year. It's strong, but a little softer 6 months ago. But that's over a broad range of business. You look at car loadings, rail car loading. That's moving goods around. And there again, that was affected by the tariffs too, because people front-ended purchases, all kinds of things, always a lot of variables. But business is down, but it's down from a very good level. So I would say that looking at our 70 businesses, and that actually, they represent hundreds in addition, they're a little softer. On the other hand, I was out with the fellows from the Nebraska Furniture Mart, and their business was up quite a bit in February, but that's because weather was good. So you have a lot of variables that hit. Well, it isn't really down. It's just it leveled off and a little softer maybe now. But the tariff situation was a big question mark for all kinds of companies, and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally. Some of them will disappear. And overall, I think America will do very well. It has since 1776. I don't do it to make specific investment decisions, but I want to know what's going on. But I also don't think that I can make money by predicting what's going to go on next week or next month. I do think I can make money by predicting what's going to happen in 10 years. Certain businesses depend on weather to quite an extent in retail, for example, in given months. But the big trends you see are going on. I mean, in terms of the movement to online commerce, and big stuff keeps moving. But we've got a big investment in the airline business, and I just heard even more flights are canceled and all that. But flights are canceled for weather. It so happens in this case they're going to be canceled for longer because of coronavirus. If you own airlines for 10 or 20 years, you're going to have some ups and downs in current business, and some of them will be weather-related, and they can be all kinds of things. The real question is how many passengers are they going to be carrying 10 years from now and 15 years from now, and what will margins be, and what will the competitive position be? But I still look at the figures all the time. I'll admit that. Our largest position is in Delta. 3 of the 4 positions are mine. One of the positions is one of the other fellows, the 4 positions. But we own a very roughly 10% of the 4 largest airlines. It'd be very unlikely we would do that. I'm not saying it's impossible, but it's complicated. Well, for one thing, they're regulated. There's an interplay. I'll just give you an example, not that we're doing, but with Delta, we own 18% of American Express, and American Express is a bank holding company, and bank holding companies have limits as to what they can do, and we're a passive holder of a bank holding company with American Express, an airline that was tied up with them. They'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions. If to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. There's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of. I get pretty close-mouthed when it comes to what we're buying. Anything that we own, we like. And there's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher. I won't give them any advice specifically on Wells Fargo, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But we sold well more than that. We sold Wells Fargo in the 4th quarter, and we sold it earlier. We don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice. We bought Bank of America, and we sold some Wells Fargo. Generally speaking, there are a lot of other variables too, but the banks are going to make more money if there are higher rates with a steeper curve. Curve is more important. In other words, the 10-year versus short-term rates may make more difference than the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well. The 10-year at 1.4%, that means you're paying 70 times earnings for something that can't increase its earnings for 10 years. If somebody came to you with a stock and said, this is a terrific stock, it sells at 70 times earnings, the earnings can't go up for 10 years. Say, well, explain that to me again. We've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones, and they don't talk about negative interest rates. It never crossed their mind. With supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. We've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation. Well, interest rates are the basis of all value. If you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put on the gas even further. The whole world has. It's bad for insurance companies, but it's good for stocks. The ones that really get hurt on are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear. If you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I've saved all this money all my life, and now I can only get 1% out. What do I do? The answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%. You see that in called leveraged loans and weaker covenants. No, people are reaching for yield. There's no question about that. And that's stupid. And it has consequences over time. But it's very human. It's something that things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. But eventually you get to midnight and everything turns to pumpkins and mice. It depends on the average maturity of the debt. But our maturities are fairly short. They've gotten lengthened a little. But if you take 20 trillion and you're borrowing at 2%, you've got 400, what have you got, at 2 trillion to 200 billion? You got 40 billion of expense, but if it goes to 5%, you got 100 billion of expense. I mean, we are benefiting enormously in our national budget by the fact that interest rates are very low. And so interest cost has not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, but 2% or thereabouts, but it's great if you're a borrower to have cheap money. I mean, everybody should refinance their mortgage. Same thing 5 or 6 years ago had been wrong. If we, under the present slope, it still would cost more to lengthen it out, but you're lengthening it out at very, very low rates. And well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, that's roughly a 3% decline or thereabouts. I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. I can't think of one that you shouldn't have bought on. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheap. How can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it can be 2% less than they offered you yesterday.